"Don't fight the Fed" has been said many times in the comment section of my videos, and in many ways they are correct. Following the Federal Reserve or Fed's lead on interest rate policy and economic growth projections has actually accurately predicted market tops and bottoms since the great financial crisis nearly 14 years ago. On today's video, I'm going to show you that timing the bottom in today's market could be as simple as waiting for the Fed to pivot again. For more than a decade, the Federal Reserve has maintained historically low interest rates and engaged in a practice known as quantitative easing. Knowing the plumbing of how quantitative easing, or QE, actually works is less important than knowing the results of it. Real asset prices tend to go up because the alternative, like a bond or simply saving money in a bank account, actually earns almost zero interest. And it's worked. Over the past 14 years, everything from real estate to baseball cards to Rolex watches and certainly stock prices have soared in value. In late 2015, the Federal Reserve indicated they'll gradually start raising interest rates, but it really wasn't until a few years later in 2018 when they really got serious, raising the benchmark interest rate 4 times in 1 year. Well, the stock market didn't like that, and stocks fell 20% in less than 3 months in 2018, leading to the now infamous Powell pivot. Instead of raising interest rates in 2019 as planned, the Federal Reserve decided to actually cut rates that year, and stocks love that. In January 2019, the S&P 500 index rose 25%. Stocks continued to feed on that low interest rate, and they ended up peaking in February 2020 when, of course, COVID-19 reached the shores of the United States. Despite the global pandemic, governments around the world were making it rain with taxpayer money, handing out stimulus checks and loans for businesses that were mostly forgiven. The S&P 500 rocketed higher, and with good reason. There was more free and cheap money floating around the system than ever before, but the good times had to end. The combination of all those stimulus checks and ongoing supply constraints caused consumer prices to start rising rapidly. Consumer prices were steadily rising in 2020 and rose to more historically high levels in 2021. The Federal Reserve infamously referred to the high inflation as transitory or temporary because of supply chain bottlenecks and the economy reopening with pent-up demand. The inflation was supposed to go away on its own, but it didn't. In fact, it was only getting worse. That caused the Federal Reserve to pivot again. Instead of keeping the easy money party going, Jay Powell was going to have to break this party up. Just like in 2018, Jerome Powell indicated the Federal Reserve would need to start raising interest rates and end quantitative easing, this time to slow inflation. And the S&P 500 in 2022, just like in 2018, doesn't like that. Since the Fed's announcement higher rates are coming and QE is ending, the index is down over 15%. There's clearly a correlation between low interest rates and high stock prices. So when is the Fed going to pivot again? Or in other words, when is the Fed going to give up raising interest rates? Well, we know the Fed is raising interest rates today to control inflation. Obviously, when the consumer price index, or CPI, starts to trend down, the odds get better that the Fed is about to pivot. I would assume stocks will move before the Fed actually pivots since the CPI data is announced monthly. But keep in mind, the Fed could err on the cautious side, waiting months, if not years, of consistently low inflation before they change the policy. The other indicator the Fed watches closely is the unemployment rate. Right now, unemployment is historically low. However, we started to see anecdotal evidence combined with actual forecasts from major companies that layoffs might begin. During earnings call recently, Amazon, eBay, Etsy, Shopify all indicated that sales for the upcoming quarter were going to be lower than previously anticipated. The combination of the high inflation and now rising interest rates is starting to slow demand. This slowdown should cause inflation to go back down, and it may cause unemployment to go up. Low inflation and unemployment going higher would cause Jerome Powell to pivot again. So what's an investor to do? As always, that question is based on time and risk. Anyone close or in retirement will want to tread carefully. Keep in mind, we've only discussed the bull case scenario today. What if inflation doesn't go down much at all, or worse yet, keeps going up? A retiree with plenty of cash sitting around will earn a ton of risk-free interest since rates will have to soar. Maybe more on that in another video. Longer-term investors like myself should be closely monitoring the inflation and unemployment data since the Fed will likely tie policy changes to that. The longer inflation remains high, the longer the higher rate cycle will be, and the longer stocks will decline. If inflation retreats quickly, the Fed's interest rate policy is still historically low, meaning the Fed might not have to pivot back to QE to have an easy monetary policy. That's the soft landing that Powell hopes to achieve. One thing is for sure, you don't want to fight the Fed as stocks are going up or down. Right now, the Fed is trying to slow down the economy, and until the Fed signals a change in interest rate policy, it's safe to assume the direction of the stock market will continue to go lower.